A fund manager determines what investment strategy is used to invest your money. Their function also includes overseeing a unit trust and managing trading activities. Ultimately, their decisions impact the overall returns of a unit trust. Puseletso Mbele has a BCom in risk management, and she joins me right now in the studio. Her career began in 2005 as a foreign exchange consultant at First National Bank, and she went on to Novare Financial Innovation, where she was employed as a research sales assistant, responsible for data research. In 2010, she joined Investec Asset Management as a direct desk investment consultant. Later that year, she was promoted to client services consultant. Mbele was appointed as portfolio manager assistant at Sasfin Securities in 2014, and she joined Riskura in November 2014, that same year, as client services manager. Her responsibilities included investment manager research and reporting on client performance. She joined Novare in October 2015 as a fund manager, and in January 2020 was appointed as head of investment consulting and is responsible for overall client fund management and relations. She's based in Johannesburg with 17 years experience in the industry. That's quite an intro, Puseletso. So tell us, I think the obvious question is, why do we need professional teams to help us select fund managers?
Thank you so much, Ciaran. So, I think you'll appreciate that when you look at the universe, right? There's so many asset managers out there. They all, say they do different things. They give you returns. They promise returns, but how they go about doing so is quite different. So even themselves, they're quite different, So I think when you are, as an investor, in understanding your investment goals and what you want to achieve, it's quite important that you then pick a fund manager that's actually going to help you in doing so. So it's then very important that you have people like ourselves or companies like ourselves as Novare that actually help you navigate the whole investment landscape when it comes to choosing an investment manager, because obviously it makes to make sure that it takes your risk appetite. It also takes everything else that you consider when you want to invest.
Okay, let's drill down a little bit on this in the selection of a fund manager. If you look at passive investment funds, why would you need somebody to help you select a fund manager? Because I understand that that's pretty much an automated process. I can understand it for an active fund manager, but I'm less sure about a passive fund manager. Maybe answer that one.
Okay, so yeah, that's very true. The process is automated, right? But it's also important to then understand how that automation is actually happening. What is the investment approach that is actually being employed in replicating that index? So, and as you know, a lot of these houses that actually do index funds, they use different tools. So the replication of it and the optimization strategies are quite different. So it's very important that you understand the nuances alongside that. So, for example, the rebalancing. How often do they rebalance? If the fund manager does rebalance quite frequently, that's not really what you want, because that rebalancing can lead to higher costs. So you also then want to then be able to say, well, how much do how often do they provide you with daily reporting? And that's also important as well, because if it's done daily, then it means there's more transparency. And then you also look at the tracking error, that the fund manager actually has when you check the tracking error relative to the excessive returns. So you actually want to see how do they really deviate from that, from that. And I think another important thing that people don't actually pay in mind is that the assets under management matter on a passive component, because obviously if the fund manager is quite big, even though they're running a passive house, if it's quite big, then it's easier for you to actually get in and out. So liquidity is then important again. So as much as it might be a passive component where you think actually you can just close your eyes and dump your money there and get out, like sit back and relax, doesn't really quite work like that, because all these other nuances you need to really think about. So even the reputation of the house that you're going to be investing in then does, it's quite something that you can't not take into account. So the size, I would definitely say the AUM is very, very important. I need to know that actually if I invest and then maybe 2 days later I need to do a redemption, it's quite easy for me to do so. so. So yes, I would say that it's as much as it's passive, and I know with like active, it's more high conviction, and you really have to apply yourself. I do believe that also with passive investing, you just have to follow the same process, because even then the systems as well that they use to rebalance and replicate and all of that, they need to be well resourced and researched systems, and the team needs to be capable in doing that.
Okay, talk about some of the specialities that we're seeing coming out in the investment field. I'm talking specifically about transformation, ESG, which is environmental social governance. Climate change is another one. How important are these in the selection of a fund manager, and how much emphasis are your clients putting on those aspects?
Okay, so I think, like for me, so as an investment consultant, consulting to institutional clients, they are governed a lot by the investment policy statement. And, you also then have the regulator, which has also had certain circulars where it basically tells them that how they need to think about the environment when they invest. So climate change has gained momentum, and rightfully so, because obviously when we, how fund managers invest have an impact. So, and we outsource our responsibilities to the fund manager. So we give them our funds, and then we then say, go buy us a Cecil, go buy us a ShopRite. But what are the nuances? They need to engage with management. So we need to actually hold them accountable to make sure that they engage with management in addressing some of the inequality issues, in addressing diversity, and just like gender parity. That's very important, like the environment as well. I'm not going to drill too much on Cecil, but like all those things need to be factored into. So therefore, having an asset manager that really thinks about those things is very important, because there's been so many research papers that actually prove that having a fund manager that selects or invests in good quality companies does lead to sustainable, good adjusted risk returns. So, they actually go hand in hand. And that transformation and the climate change and the governance does not only extend, or I suppose it's not only limited to how the fund manager allocates or invests, but also the business of the fund manager itself. When you look at the fund manager, the team, how diverse is the team? And I think, with the work that we do, we always interview a lot of asset managers as part of our manager due diligence process. So I've seen that there's actually a strength in diversity. There's different idea generation comes from that. Actually having women, it adds a different dynamic to the team. So all of those things are important. You want a team that's quite diverse. You want a team that's really representative to the demographics of this country. You want a team that has a very good track record, that really works well together, and that also adheres to the portfolio and construction process. And even when they deviate from actually maybe a certain stock, you actually want to understand why they're deviating and what are they going to do about it. Because if you look at South Africa, especially our JSE universe, we're quite limited. I think there's like probably 150 investable stocks, so it's not as if like we have a lot of pool to choose from. So if someone really decides to have a Cecil in the portfolio, then they say, okay, fine, I'll have a Cecil, but what is my engagement with Cecil going forward? What do I understand about them actually transitioning the company into a more sustainable house, even for ShopRite, even for Capitec, so there's all those conversations. You need to make sure that your fund manager is actually able to be your activist on your behalf, because you outsource and then you go about your daily life, but you need to actually trust that they're able to do that for you.
It does raise an interesting question as to why these companies that are more transformed and that do incorporate policies for climate change and ESG, why they are more highly valued. Is it because people are prepared to pay a premium for those companies, or is it because they're better run, the management internally is better quality?
I think it's better run, it's better quality. But I think you've seen that, if you look at the King 4 report, right? If you really invest and think about or run your business with that kind of mindset, where you not only actually just think about your profits, but also around your communities that you operate in, it will definitely have a spillover effect. So it's not just only you benefiting, but your community benefits as well. And I think that's why you sort of then get those companies that's how they end up doing so well, and I think a lot of that is also starting to change here in South Africa, especially around like the platinum belt in terms of how, your mining companies are investing. They're also starting to think differently to say, what impact are we having in our communities? So it's not just about mining and, taking the profits out, but how do we then give back? And I think then that's more sustainable.
Right. Talk about the due diligence that you do, because you've got a tremendous number of fund managers, both locally and offshore. That's a lot of ground to cover. How deep do you go into each of these fund managers, and how broad is that universe? How many do you cover?
So, obviously I'm going to be speaking about Novare here, but we do a full-scale due diligence, and I think what is great for us is that we've got a proper manager research team. So we have over 9 investment professionals that do manager research due diligence every day, and we cover all asset classes. So South African equities, fixed income, property, as well as offshore. And offshore as well, we cover the same asset classes. And we're also not limited to that. So we do unlisted as well. So hedge fund, private equity, venture. So our manager due diligence really starts from a high level where we look at the survey, the returns components, how are the managers performing relative to their peers, and then from then on, we then also scale it down to then narrow it down to your manager research questionnaire, where they have to complete our manager research document, which is always continuously enhanced, and then from that process, we then discuss it internally with the team, and then from there, if you like what we see, we then invite the manager for further on engagements. We'll have like a presentation, and from that standpoint, we then after we've had the presentation, we then do the operational due diligence, because a fund manager is going to tell you that, oh yes, we've got offices in Cape Town, I've got offices in Joburg, I've got a team of 6 people, I've got these systems that I use, but really, how do you know? So it's actually important to actually now go there and test what they say and actually verify all of that, and it's quite interesting as well. People would say, you'd think that a fund manager is supposed to be, regulated. Some, they are so interested in starting the business, they forget all the legal aspects. So we have to make sure we take all of those boxes, and also then we interrogate the portfolio construction further. And once the manager, we've done the operational due diligence, we've actually engaged the team in depth. We then also have a manager scoring committee in-house at Novare. And that manager research scoring committee, based on all the papers that we have submitted, we then put the manager on our buy list. And then from then on, now there's actually active monitoring, because it's also good to have, you can select a fund manager, but now you need to monitor to actually make sure that are they actually sticking to what they had said they'll stick to? Are they investing according to investment philosophy and process, the portfolio construction, the tracking error, what other things are they actually, are they sticking to the mandate in essence? So that's like the monitoring aspect is very, very, very much important, because also things can go wrong. And I think I would like to maybe emphasize on Steinhoff. With Steinhoff, now we had to actually say, what was the investment case? How did you hold this share? And did you not see this coming? Because there's certain valuations. And so those are all the things that I suppose we take into account when we conduct our full-on due diligence. And we apply the same principles locally for local managers and offshore managers.
That's an interesting question, is what did you find on Steinhoff that, because it was being supported very broadly in this country, right up to the point it collapsed.
Right, and that's an interesting thing, because, there were actually, I remember at that time there was a fund manager that was not performing. And I think because, obviously client engagements and client pressures, they found themselves buying Steinhoff. And then this happens. And you're then saying, but for you, that's even worse, because this was not in your portfolio. So how do you then actually how did you come to that decision as a house? And I think that's where the investment philosophy and portfolio construction themes then come in, to then actually say, your fund manager, when they're under pressure, how do they stay to the course? And not get distracted, understanding that the investment objectives are long-term in nature, understanding that also for them, the investment themes that play out are also long-term in nature. So it's also important that you have a fund manager that actually doesn't deviate too much. And even when they deviate, they can actually account on why they deviated.
I want to pursue that one with you. The due diligence, the number of investment teams that you have to cover. I think you told me when we spoke yesterday, you do 150 offshore teams. How do you manage to do that? Because, I mean, they would be all over the world, and how many in South Africa?
So as I said, we've got 9 investment professionals on our side. And I think what the benefits with COVID is that now, embracing the virtual platform. So we still apply the screening process. We do have systems that actually allow us to get returns, see how the managers are actually performing. But in addition to that, we meet with the managers, and then when we are interested, we apply the same principles in that they will complete a due diligence questionnaire, and only when we think that there's actually an appetite for our clients to actually appoint this asset, the fund manager, will we then actually go and do our regular offshore visits. So, recently my colleague, Mr. Jacobus Brink, who's our head of offshore, was actually in London, and I think in the US, where he saw all the different asset managers that are actually on our buy list. So that basically happens, and I think the beauty with the pandemic is that it's actually allowed us to do more, because before you'd only see maybe, you will still get the universe, but you wouldn't be able to maybe have 10 or 9 meetings or 12 meetings in a week. So actually with the virtual, us embracing the virtual world, it's actually assisted us in enhancing our processes and strengthening engagements with asset managers.
Right, and in doing your due diligence, what are the typical red flags that would come up? Is it got to do with the balance sheet of the fund manager, or has it got to do with their processes and the way that they report?
I think the process is very much important, because the process is what we would rely on for the manager to generate investment returns for our clients. So we really look at the investment process. Obviously, the manager has to satisfy regulatory requirements as per, with South Africa with the FSCA, and I think with the offshore managers would be where they domiciled at. So that's also important. And I think the team as well is a very important component of our investment manager research due diligence that we follow, because we really want a team that is cohesive, that works well together. And we think the more time that the team is actually in, being together, we think then everyone has immersed themselves in the investment philosophy and process that they are actually trying to live by and generate the returns. And in addition to that, obviously you do want a business that is able to break even. So in understanding that, yes, you might have an asset manager that is starting out, but the sustainability is quite important to then say, at what AUM are you able to be breaking even? Are you comfortable with that number? If you don't break even in 3 or 4 or 5 years, what then? So we actually have to interrogate all of that. And that interrogation is really done on emerging managers who are actually starting out, because the guys who've got a longer track record than more than 10 years, you'd also expect that the AUM is also like quite substantial. You expect that, after 10 years, you are actually able to break even, and you're able to compensate your team quite well. We want alignment between your team and the investment team and the client, because when investment team does do well, we as a client also do well. So those are the things that we would look into.
All right, if anybody's got questions, please send them through by email to events@moneyweb.coza, events@moneyweb.coza. And we have got a question in here from Andre. I don't know if this is something you can answer. It seems a little bit specific. But anyway, during COVID times, Andre says, I terminated monthly contributions to a collection of funds via an investment platform. I then noticed that units are being sold monthly to cover fees. Although it was tough to see fees eroding away my retirement funds, I accept this. I have now also become aware of the fact that this approach raises personal capital gains tax. Is it normal for the investor to be responsible for capital gains tax due to activities required to cover fees? That's a good question.
It's a good question. And my focus really is on the institutional side. So I can't really speak too much about, like the capital gains tax. But what I can say is that obviously when you do sell, and you have to pay your dividends withholding tax, you have to pay your capital gains tax. But I think also maybe Andre during COVID, I don't think it was also the best time for Andre to have actually exited the market. I mean, the market was quite flat at that time, and I think maybe Andre should have actually stayed the course and stayed invested. Obviously, I don't know the circumstances that led to the decision to actually terminate the portfolio, but I think capital gains tax comes with
comes with the territory.
It comes with the territory.
Right. Okay, talk about costs for a moment. I mean, as an investor, you have a particular strategy in mind and you have a certain time horizon in mind as well. And if you're in an actively managed fund, you would expect to pay higher fees. But if you're in a passive fund, you expect it to be it's a very commoditized type product, so you'd expect to pay quite low fees. Are investors prepared to pay more for better management, do you think?
Yes, they are. I mean, I think it also depends on the risk budget of the client, the risk appetite that they're willing to take. So some clients do actually understand that actually, for active, it does cost a little bit more. And there's certain asset classes, if you look at infrastructure, the element of work involved, like private equity, it's quite onerous. It's not as simple as in the listed space. And so the understanding is that the private equity manager has to do a lot more, from the due diligence when buying, investing in the investing companies, the legal fees for due diligence purposes that they need to run before they actually buy that company. So, but the returns, on the other hand, could also be substantial. So if the return component is actually quite compelling, clients can pay. Clients are really willing to pay. And I think the challenge on the listed side is that we haven't really seen, there's been a very few active managers actually outperforming the index. And hence the conversation around passive then starts gaining that traction. So until, clients will pay. If they see value for it, they'll definitely pay for it. But I think, it needs to be compelling. So if the investment case is quite compelling, I do believe that clients are willing to pay for it.
Notwithstanding the fact that numerous studies show that passive investment funds that track the index or the benchmark are, over the long term, more likely to outperform actively managed funds. Yes,
that's very true. I mean, I think there's been so many journals and papers written about that. But I also think it depends where, So if you look at maybe an emerging market index, maybe investing there, you'd want an emerging market manager that is actually going to be picking the right stocks for you in Brazil. Because you might say, well, Brazil's not looking good right now. Yes, on a macro level, it might not, but there's little germs that a manager can find there. So, then that's very compelling. So I definitely think one needs to look at which index are we referring to. And I don't think it's, you can't really generalize. Obviously, your Capswix, your S&Ps, your Dow Jones, yes, that's very true. But for some, you might actually need that active component if you really want to get more bang for your buck.
All right, tell us who would be your typical client. Is it the big institutions, the pension funds?
Yes, so our clients is more your pension funds, and I think obviously with them they've got the risk budget, so they actually outsource their responsibility to us. Some of the responsibility in terms of assisting them in choosing, number one, in formulating the investment strategy, assisting them with manager due diligence research, and then obviously assisting with the active monitoring of the asset manager. And in addition to that, I mean, the work then actually extends, so you touched on the ESG component. So drafting your active ownership policies for clients, that is part of the responsibilities that we actually do. And that is also now client specific because one client might have a very different risk appetite to another, and so how they see things is quite different. So we also have to take that into account.
Okay, and one of the things that has, of course, happened in the last few years is the growing sophistication of the investment market, where you have specialities like hedge funds, private equity, venture capital, property, fixed income. Well, that's been around for a long time. But you get this very diverse investment field. That requires a lot of specialization, particularly where you're looking at non-correlated returns, which would be private equity, venture capital, and that sort of thing. How would you look at those differently to investment teams that are looking at stock market and equities particularly?
Okay. So I think, with private equity, deal origination of the private equity manager is important. You would want a manager that has actually maybe had over a 10-year track record where they're able to actually originate a deal and manage and be able to exit the deal. So those are the things that we will then look for in a private equity manager. And that's quite similar to venture capital as well, because, they might be different, but there's similarities in that they would invest in unlisted private companies. So those are the key components that are actually very important for us, because we really rely on the skill set and the integrity of the private equity manager, and then experience then becomes really, really, really important. And even for them, we understand that maybe certain advantages might have been different, in terms of like the performance-wise, and understanding that yes, the performance is not an indicator of future performance, but it gives us a base to actually and understand a thought process in how they go about this. So when we conduct operational due diligence for private equity managers, what we also then do on our side is actually engage with the investee companies to understand what other value set or skill set does a private equity manager bring to the table, other than a check, for you to either do your growth expansion that you want to do. So we also then interrogate even the ESG, governance, sustainability, environment. We interrogate all of that. And even with private equity, there's a portfolio construction process that needs to be followed. So that is also then interrogated robustly before we actually decide to go ahead with that manager. Same with property and venture. I do think that with especially for institutional clients, and I think investors in general, the risk or thinking about investing is no longer as simple. There's a lot of nuances that one needs to be cognizant of, and I think that's where companies like ourselves, like Novare, come in. Because we're actually able to bridge that gap for clients.
Okay, final question. We're just about out of time. What trends have you seen in terms of fund managers and investment styles over the last 5 or 6 years?
Oh, so I think on the listed side, it's really been your value and growth, and then the momentum has also come into play. But I think really largely because of what happened in the pandemic, you then started seeing a lot of value managers doing quite well. So that's been the most trendy, and I think that deep quality style has come through, and I think in South Africa it hasn't really filtered much, because our universe is quite small. So you'll find that a lot of the asset managers who do deep quality and follow that deep quality investment style haven't really fared as well from a performance perspective, because the selection isn't right there, especially if you're going to be really by the book about it. Yeah, so I'll say those are sort of the trends that I've seen on the listed. On unlisted, I think, I suppose it's not really a trend per the style of investing, but I think infrastructure investment is really gaining traction. Venture capital, it's a new asset class to us, and that is really gaining traction, and private equity as well.
Okay, Puseletso, thanks very much for that. We're out of time. Thanks for joining us.
Thank you.